Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. Our guest today is Amit Sachdeva, India Equity Strategist of HSBC. And they wrote a very interesting note on the 25th of March, wherein they're talking about the flows, especially from the FI side, which have led the rally, and how their observations suggest that one, FI flows can still sustain, and the risk of a sharp market decline is limited, even with moderate FI outflows, as DI should cushion the market against volatility. Amit, great having you. The first time that I believe we are talking. Thank you for taking the time out.
Thanks, Neeraj. Thank you for having me here today. Thanks a lot.
The pleasure is ours. And I want to start off with the key crux of the note that you wrote maybe 4 or 5 days back, which is around flows. So please, without me leading a question, please tell me your key observations first.
So look, India's flows is a very interesting thing because first of all, we should know where we are in the market cycle. And flows is large part of that. And why is that so? Because India is a secularly swelling, market. You don't need really much. If you take a very long view, it's a straight line going up, right? But the issue is that there different actors act differently at different times. FIs, for example, uh, take a decisive view on India in different phases. And for any phase to sustain, FI flows are very critical. So any bullish phase to sustain FI is very critical. Now, where we are right now, we have received about 19 billion inflows, right? Which makes India as one of the largest recipient of flows. About 85% of all ex-China Asia EM flows came to India. Now valuation has risen to about some degrees above five-year average, and now somebody can beg a question whether they can reverse. My sense is to get that answer, we should look at our own cycle. We had 5 large bull phases ex-COVID and 4 bear phases. Our view is that we are in the middle of that bull run. We are in the bull run, doubtless. But bull runs once set in has a little bit of momentum. Typically, bull runs in India can last up to 30 months odd, right? Unless they are broken by some major event. And what those major events could be is a global crisis, large onset of inflation, or something really going wrong with crude, right? These 3 major things can break a bull run. We are in a bull run, but 2 things have happened which we should be aware of. Number one, market breadth is 83%. And also the valuation is little above mean, so some discomfort there. We've seen crude uptick very recently going up. But I would argue valuation is still tenable. FI flows, although have come in, they are about 0.7% of the 12-month market cap. Peak bull run is about 3% of market cap, and average of bull run is 1.7. We have a little bit room to grow. And why is that so? Because we have seen 15 months of incessant outflow. And so the base is still benign. Valuation is tenable, and also FI ownership of Indian market is about 17.9%. Still below cycle average of 19 and much below cycle peak. So in some sense, although FI flow seems look good, it still has a room to do a little bit more. But breadth of 83 is a bit worrisome. But what it tells you 2 things. Number one, 83% breadth can sustain if other things are good. But earnings are also good. So long as earnings are sustained, this breadth can sustain even for a year. But if, for example, few other things go wrong, like crude goes very high up and earnings are downgraded, then probably this rally is broken. So in some sense, if earnings are good, which I think looks good, and crude is not going out of whack, we have a Goldilocks scenario. And if I flow base is benign, that would suggest that any outflow will be very shallow and short-lived. Market has still room to expand.
Got it. Amit, just to put this into perspective, ceteris paribus, if crude doesn't go out of whack, it's risen for the last 4 weeks, but let's say it's circa $85-$90 to a barrel. And if earnings, which have largely been in line thus far, continue, then you are seeing even for average cycle flows to happen, there is a lot of room to go, because I heard you say a statistic of 0.7, 1.7 for averages and around 3% for peak. So we're still some time away.
Yeah, we are at 0.7%. It is. Let me give you a perspective, right?
Sure.
When the COVID happened, we received 34 billion inflows, and when the money was being printed, liquidity was very good. And between October 21 to June 22, uh, markets saw an outflow of 32 billion. So almost entire flow that came in went down. Market was down 15%, cushioned by DI flow. Since then, we have seen only intermittent flows, but largely outflow. So if I ignore the period till March, we've seen 15 months of just outflow. It's only 5 months we've seen unflow. Although it looked high, but we're sitting on a very benign phase. Most funds are still underweight in India. Although flows have come in, regional funds, global funds are underweight. So my sense of the crude is that if crude does not touch beyond 90 or 100, we are okay. So look, if you look at the long history, crude is a non-event till 885. It doesn't matter. But if becomes say 9500, then other things don't matter, how good they are. So it becomes a binary event which overshadows a lot of things. And hence I said that, well, we are looking at crude, at least the HSBC view is that crude is unlikely to go to that level. And next year we're looking at even softer crude. But if some event were to happen that crude suddenly reaches or appears to be reaching 9500, then you would see markets snapping back as a snap reaction. And flows tend to sort of preempt that and become negative. Second could be if inflation were to go out of control suddenly and seems like, and then what happens is market preempts that and flow can turn negative. So inflation, crude, and also maybe protracted US recession, you could worry about. But if these two factors are okay, you can tolerate that. Rest every other scenario in Goldilocks seems okay to me.
Okay. What about central banking action wedged out here? Because we talk about March. March was around the time when the commentary of the big four central banks kind of turned a bit, if I'm not wrong. And of late, we've seen maybe not fully hawkish, but certainly not dovish commentary. Does that play a part in this whole theory of flows into EMs and India?
It does. I think Neeraj is a great question because look at, for example, I mean, that gets summarized in US bond yields, right? Any action, for example, or any anticipation by market. So bond yields are today at about 3.9%. It's come down from 4% just a while back. So my sense is that it summarizes those expectations, and I think we can't rule out one hike may happen, and some commentary is still not dovish enough. But it's fair to say that market has discounted that in its own expectations, and hence this is not a major risk if that commentary sort of remains in this range. While inflation, for example, domestically is a thing to watch out for, what it means for even central bank action here, for example. That I would leave it to economists to obviously comment upon. But at the same time, this is something that is worth keeping an eye on. Given the July inflation could be inching up further from May, June. June was higher than May, and July could be higher than June. So in some sense, that situation needs to be monitored, I think.
Okay. So would there be something in the global central banking commentary that would make you change your current view? Everything else remaining constant. Can that alter the view of inflows in any fashion? Or you believe that is not as important as some of the other two factors that you spoke about?
I think those are largely discounted risk. Any stock change from that seems unlikely right now.
Okay.
From India's point of view, given the India's growth outlook is quite standout, earning outlook is very good, and India's structural appeal is on the rise. Many funds are just waking up to invest in India. So it's a new form of attractiveness that India has sort of seen. So my sense is that in this environment, any correction could be very shallow, and probably many investors will use opportunities such as these to buy into India rather than worry that more sell-off is coming. I think the bullish construct has certain legs to it. Unless
Got
you
it.
see major downgrades or earnings, etc., or inflations or some other macro things going wrong, which doesn't seem likely, you could see intermittent some consolidation. Every bull run, for example, has intermittent phases of consolidation. Bull run is not every month market going up. It goes up 3 months, then it corrects 1 month, goes up 3 months. But if you analyze the last past bull runs, you'll realize that those phases have generally 3 months rise to 1 month fall, to 3 months rise to 1 month fall. Those phases aggregate to become a bull run. So we should not worry about smaller consolidation. I think if general construct remains like this, I think it's a Goldilocks scenario for India playing out, and we are in the middle of it.
Nice. I mean, what I heard you mention about how a lot of funds are waiting to get into India. It must be a good time to be an India equity strategist because earnings are looking okay. India is being favored, and people want to get into India. What are clients telling you? Both existing clients who have money into India, and also some that you might be meeting who might be prospective clients who might want to be getting into India. What are the conversations like?
I think the bigger conversation is a uniform acceptance that India is a great structural market, number one.
Okay.
The only, and also macro is stable, and this is the growing acceptance that it is structurally appeal of India is massive. Third, there's a grudging, bemoaning of the fact that valuation look always out of reach, and something that people want a bit of a consolidation phase to emerge, and they buy into it. So everybody would definitely, whoever I speak with, tend to seek comfort in valuation. Very rightly so, because we've seen the period of 2022 and 21 excessive, where markets corrected, and people want to avoid that level of bullishness that you're buying growth at any price. So market learns quickly, and I think that's where the worry is. Are we in that zone where you are paying already excessive valuation? So market is cautious on paying too much of premium, but yet looking selectively for the opportunities. My sense is that uh, this year would be largely earnings driven. And why do I say so? If you analyze past cycles, market breadth when reaches 83%. When I keep talking about breadth and breadth, see, when the market is going to a trough, the breadth falls over 5 to 10%. At the peak of bull run, that touches about 98. We are at about 83 right now, right? What does 83 tell? 83 tells you that I can sustain this phase for at least a year if earnings are really good. But at this breadth, multiple expansion is very diminishing. So market gains incrementally becomes very earnings led. Resilience of earnings, downgrade should not happen. Market doesn't tolerate earnings downgrade at these levels. So one must avoid those scenarios where you're buying prospective earnings which could be subject to downgrade. So that tolerance becomes low. That's the market cycle teaches. So in some sense, we can tolerate this spread, we can tolerate this multiple, we can tolerate this flow, provided India delivers on earning expectations.
Mm. Okay, and I'll get to earnings as well, but one last question on flows related. You note in the report that you've written as well that even if there are moderate FI outflows, the DII flows would kind of cushion against the volatility. Now, my want of understanding is based on how you analyze past cycles, based on your analysis of both DII and FI flows, as well as money waiting on the sidelines, other things remaining constant. If we were to get into a corrective mode, at what levels would you be comfortable telling your clients that, okay, I'm telling you, come in and start putting in your money?
Well, we are regionally overweight on India. On a GEM perspective, we are overweight. India is one of the favorite markets for HSBC. So that is a given. We are telling clients that we are overweight on India.
Okay.
Number one. Number two is basically your question is that how do we basically go into the sorry, what was your second bit that you
My question is, if we are to get into a corrective mode, what levels or what valuations would you believe you will be comfortable telling your clients that you are confident of putting their money to work?
Oh, okay. See, look, we are comfortable. That's the reason we are okay. The only thing is that I can share the benchmark. For example, in a trough year, right? In a peak of the bearish run, peak of the crisis year, valuations are 11 to 12 in India, had not fallen below that. In a normal bearish year, right? India is about 16, 17, right? In a typical normal cycle, we are 18, we are at 20. So where we are. So if you invent a very bearish year, right, we will fall to 16, 17. It's a no-brainer if no crisis is coming. This is a if 16, 17 valuation were today, I would say probably it could be a larger construct for a sustained bull run. It's
Got
20,
it.
then I'm looking for more earning resilience because it can mean that there are pockets of stretches one must avoid. And
Hmm.
hence the market, even if it's in bull run, would seek sectors and rotate risk where the underperformance is lying and earnings could be good.
Got it. So where is what fits the bill then? I mean, because there are some which have gone beyond market-wide valuations as well and beyond their historical valuations, never mind the earnings. So I'm just trying to understand, could it happen that the market stays flat, but there could be rotation happening and some undervalued sectors right now come to the fore because there might be earnings there, but the valuations might be benign.
Right. So we have many cases in point, right? So there are two dimensions where you can look at all the sectors. How optimistic the investors are, how positive the business dynamics are, right? Ideally, you want to be buying when investors are pessimistic and dynamics are positive, right? And where or at least dynamics are positive and investors are optimistic, but I can still see momentum going on. But that's a risk off market, where market wants to take minimum risk. What if market is risk on? Whatever market wants to play the cycle which is not yet arrived. Then there's a third quadrant, which is investors are bearish, market dynamics are also negative. Their outperformance can come from sectors which are currently doing very bad. For example, I would place IT in that bucket. You know, in our framework, IT stays in that quadrant where business dynamics are obviously negative, but investors are also pessimistic. In the 19 billion flows that we've seen this, from April, uh, only sector that has seen major outflows are still IT. So in some sense, IT underweights have risen, and at some stage where the valuation has become, very reasonable and dynamics are bottomed out and other sectors have run a lot, uh, I wouldn't be surprised some amount of rotation taking and seeking such sectors. I'm not saying IT, but I'm just saying that those have consistently performers in the past and they are now well positioned to attract risk on flows of some sort. I hope that answers your question. So
It
financials look
does.
okay to us in terms of as a positioning, and even selected consumer discretionary consumer staples. We believe are little going towards the last leg of rally. Although the margin expansions are largely reflected in stock valuations in some sense, but earnings outlook seems to be okay.
Okay. Sorry, did I miss you saying banks? And I'm wondering what your thoughts on banks is. Not BF, not NBFCs, just banks.
Financial fees, we largely like private banks, to be honest.
Okay.
And that's where our teams basically are focused on largely. And we have recently also upgraded some names in the NBFC space as well.
Got it. What
I
about
would,
underperformance?
yeah, sorry.
Sorry, what about underperformance? You mentioned IT that at some point of time, who knows, there might be rotation there. There are a few laggard sectors which have started to now see fancy. I mean, the month of July has seen Pharma do amazingly well. For the last series,
Right.
Pharma was the best gainer. There are a couple of other pockets which are coming to the fore. Any interest there?
See, what I'm saying is those sectors are definitely case in point where when market is in a risk on, market wants to believe and play the improvement cycle. Although the business dynamic in pharma are yet to show up, right? But at the same time, any news flow which suggests that there's a shortage of drugs or something like that, because the underperformance of the past, things can rally a lot, in some sense. So those are the
Okay.
sectors definitely are should be on the radar screen. And as the business dynamics improve, they would go to the first quadrant where investors are negative, business dynamics are improved,
Got it.
which is an
I'm
outperformance sort of quadrant.
Okay. Okay, get it. I've one final question, Amit, and and that is one of your peers happened to mention this in an off-air chat about how while they are constructive India, they are closely watching out for announcements from China because China is just so cheap that if they do announce a stimulus, then FIs could well prefer what they did until March, which is sell India and buy China. Is that a fear?
Right.
Because you mentioned some mention around how it's not a zero sum with India on average. Would love to understand more.
So for that, we must understand short and long cycle both, right? In the short run, India rallied because uh, China was going out of favor, recovery was below expectations. Why it underperformed in the first, for example, quarter was because China was supposed to open up, and also the valuations were very excessive, and there was a slowdown, and so many things factors came together, and India sort of the sell off that we saw in the first 3 months. Now, if China were to sort of do a macro surprise or a stimulus, there is a definite, risk of some outflows, doubtless. But would it be very deep? My sense is less because China has seen more tactical, unless some decisive structural attractiveness and performance, become visible. So, in some sense, some rotation may happen, but not a whole lot of great deal. Second is basically if you look at the long range cycle, China and India flows are not mutually exclusive. And then most of the year, uh, both the markets have basically gained flows at the same time. It is not if you were to buy China, you have to be underweight India. That is not the case over a long term cycle. And thirdly, basically, I would probably think that so long as India's earnings are okay, valuation is not out of whack, right? If valuation was say 23, 24, and then there was a case that deeper correction is needed, and let it that be an excuse. Our view is that well, China recovery is a bit of a risk, but it would probably be very shallow risk for India.
Okay. Point well taken. Amit, thank you. It was a lovely note to read, and thank you for selecting some parts of it and talking to us about it. We hope it's even better than that for India, but thanks for taking the time out.
Thank you so much, Neeraj, for having me here. Thanks a lot.
So the pleasure was entirely ours, and viewers, thanks for tuning in.